Good morning. It's Monday, the 10th of June, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital, where the good news is that we've seen the first signs of rains on Sunday morning, at least where we are in central Mumbai. Before I start, it is evident now that the markets have been swinging quite wildly in the last week, and of course so much that we have ended up better off than where we began. And like I argued last week as well, it would have done you good to take a figurative vacation from Saturday, the 1st of June to Friday, the 7th of June. You may have lost a little or even gained a little, but largely you would have been in roughly the same position on 1st or 7th of June, and I can assure you would not have had as many dark circles under your eyes. More on that shortly. I don't mean the dark circles. The larger takeaway, of course, is that it is most dangerous to time markets around big bag events like election results. It is, of course, worse to take cues from exit polls and the like. Speaking of which, the problem works both ways. Let's imagine the exit polls that we've all discussed so much about were right or close to right as opposed to being so inflated as they were. What would have happened? Well, the markets would have crashed exactly as they did on June 4th, but except that they would have crashed on June 3rd. Now, June 4th was the day the votes for the general election 2024 were counted. But then, like I said, they would have crashed on June 3rd, the Monday they opened for trade. What would have happened after? Well, they would have quite likely risen again on the 4th of June because the markets would have seen that the situation unfolding was not some doomsday scenario. And thus, would come to a somewhat rational conclusion that the results, technically speaking, were pretty close to what they had priced in themselves in the last few months, which is the BJP coming back to power. Yes, it is in a coalition amongst or with two other allies, and that changes things a little bit. But this is all theoretical. But the fact is that whichever way they move, the exit polls are an unnecessary emotional trigger for the stock markets, which we can do without. And there is another external factor that clearly influenced the markets in a manner that it should not have been allowed to, which is politicians making very strong forward-looking statements about markets. They should not be allowed to do so, as companies are not allowed to do so. I think we really stretched things this time. Regulatory agencies should put out clear directives which prohibit politicians from making statements about markets except through the rear-view mirror to take credit for the past for which they're most welcome and entitled to. Which brings us to the top news and themes for the day. Friday sees a 1,600-point jump as the market settled down to a new order, could stabilize further. China slows down on buying gold. Will that affect prices? India's medium-term growth targets, revisiting them in the context of a new government.
This is a core report with Govindraj Ethiraj.
Friday's unexpected moves. Now, the stock markets were expected to rise and stabilize since it was clear that the new government was set to take charge yesterday, that's the 9th of June. But the 1,619-point jump was a bit of a surprise to many market players. I was a little surprised too. In context, the Nifty has added about 3.4% last week, while the Sensex rose about 3.7%, recouping all losses made on Tuesday, June 4th. And now the Nifty has logged its best week since early December, while the Sensex recorded its best week in nearly 2 years, according to Reuters. Bank stocks drove the index after the Reserve Bank of India left interest rates unchanged, and more on that shortly, during its June monetary policy. That and the anticipation of stability within the coalition government at the center obviously helped. The BSE benchmark closed at 76,693, up 1,619 points on Friday, while the NSE Nifty50, on the other hand, ended at 23,290, up 469 points. So both were in the region of 2%. The mid and small cap indices also rose around 2%. Now, there is a lot of data flying around on foreign institutional investment and domestic institutional investment, which includes obviously mutual funds in the stock markets. Now, I feel this is very misleading and being totally thrown around without context. FIIs, in all my understanding, come and go as they have for 3 decades. Now, there is nothing in their behavior that suggests they are buying differently from before. Domestic investors at this scale are a newer lot, but they've not seen real fear grip the market, so we don't know how long they will continue to invest at this pace, when they will pause, when they will take out money, and when they will come back. The bottom line is no market goes up all the time, as some geniuses would like you to believe, nor will there be continuous flow of portfolio funds, including domestic, as other geniuses would like you to believe. And equally, nor do markets go down all the time either. So be careful of both, particularly advice. to that effect. Elsewhere, in a sign that fresh supply of stock will keep coming in to make good use of all the money that investors are pumping into the markets, Bajaj Housing Finance has filed with the Securities and Exchange Board of India to raise up to 7,000 crore rupees, or about $838 million through an initial public offer or IPO, it said on Saturday. This firm, a unit of non-bank finance company Bajaj Finance, will raise funds through a primary issue worth about 4,000 crore rupees. Reuters said this is the first high-profile firm seeking regulatory approval for an IPO after the national elections. India's medium-term growth outlook. Speaking of finance, the Reserve Bank of India's Monetary Policy Committee kept the key repo rate unchanged at 6.5% for the 8th consecutive time on June 7th. The MPC, that's headed by the Reserve Bank of India Governor Shaktikanta Das, also decided to continue its stance of withdrawal of accommodation. All this was seen as good news for the markets. So let's pick up on both interest rates and the medium-term growth outlook, both key contributors to how the markets are perceiving the near future. I spoke with CRISIL Ratings Chief Economist DK Joshi on the Core Report's weekend edition, and I began by asking him first how he was projecting India's growth outlook in the context of India's continuing economic agenda, and then some context on interest rates and where we stood right now, particularly after the Reserve Bank of India's decision.
Well, I think we do medium-term projections for the economy, and I think we've used the SOLO framework, which looks at the role of capital, the role of labor, and the role of efficiency in driving medium-term growth. And our forecast is 6.7% per annum till the end of this decade, which is actually not very different from what we achieved in the decade before the pandemic. India grew at 6.6% per annum. But the difference would be because the size of the economy has become larger. So even maintaining that growth rate yields compounding benefits for the economy. And I think the size of the economy will expand and per capita incomes will also rise if you manage to grow at this rate till the end of the decade. Now, very quickly on the drivers of this, what we find is that 53% of this 6.7% growth will come from capital because investments have been the key driver of the economy. I mean, investment to GDP ratio is rising, and the public investments, the household investments, both have contributed to it. And I think there is a way for private investment to become broad-based. But investments seem to be the key driver of growth over the medium run. The second driver is efficiency. And the third is the labor. Now, the contribution of efficiency is about 30% of this growth that we are projecting. And the reason is because if you build infrastructure, if you digitalize, and if you do some reforms, I think you get efficiency benefits out of that. Just to give you one quick example, I mean, if you build a road which is wider, the trucks will move faster on that. They'll be bigger in size. So you'll get some efficiency out of that. If you digitalize, then your choke points get reduced. For instance, I think you have pass tagging so vehicles can move faster. And then if you have reforms like GST, then I think you remove the checkpoints. You've got rid of the octroi points. So that also reduces the choke point. So I think the point I'm making is that all these three things come together and promote efficiency in the system, which essentially means that with the same amount of labor and capital, you can produce more. Now, the contribution of labor to this growth is the least, 17%. And I think the reason for that is women's participation in labor force is very low. And I think the economy is more capital-driven, and automation, etc., are reducing the need for people in general to fire growth. So the contribution of labor continues to remain quite low, and I think is projected to remain low unless I think you take steps to improve that. So that's the broad medium-term projection for the economy and the key drivers.
So the interest rates have not been changed. Globally, the interest rate cycle seems to be shifting. The European Central Bank has raised, and others might follow, or at least that's the feeling, which is the Federal Reserve. But India at this point is not raising. So in what way do we interpret that signal at this point?
Well, I think just to give you a global backdrop to it, I think when the pandemic struck, everybody cut rates. It was a synchronous rate cut cycle. Then when inflation suddenly appeared and became a monster, everybody started raising interest rates, and that was also synchronous. But now what we are seeing is that it's the end of the rates hike cycle, but the different countries are going to respond differently depending on their domestic conditions. It's not going to be a synchronous. We've already seen the two most connected parts of the world acting differently. US is talking of higher for longer, whereas Europe has already started cutting rates because their growth rate is anemic. Now, within that, I think when you look at India, India's inflation is not that big a problem right now, but the food inflation is, which is related to weather. Now, since growth momentum is strong, so the central bank has the policy space, so to say, to target 4% inflation. Earlier, the band is 2 to 6%, but I think it's a too wide a band. So now, since they have got an opportunity because of high growth, so they are focusing on inflation, in bringing inflation down to that medium-term target of 4%. So that is why my sense is they are going to remain in that position as long as it is possible. And we don't see a rate cut happening before October this year. And after the monsoons have played out, I think we'll have more clarity on how much the food inflation is going to go down. And actually RBI today flagged that the inflation is gradually coming down, but there are a lot of domestic as well as global risks to food inflation. And even commodity prices have started rising. So they are all in a very cautious mode. I mean, globally as well as locally, I think the central banks are on the side of caution. They don't want to take a chance again.
Right, but the factors of inflation, and you talked about food, I'm assuming are different in India compared to other countries. And within food, you talked about vegetables. Now, is that only linked to weather, or because it's been around for a while and consistently rising, isn't it?
Well, I think agriculture is very closely related to weather. I mean, unlike other segments of the economy. So I think it is the persistence of high food inflation is related to weather. I think if I take you back to 2022 when it started, I think the heat waves actually that reduced the wheat output. And after that, I think the global shortage and several things played out. Today, I think the problem is the most volatile component is vegetable. Vegetable is witnessing 27-28% inflation right now. And that has to do with weather. I think, the shock from food, central banks typically ignore as transitory. But if the shock persists and vegetable inflation shock, the food inflation shock has persisted for quite some time. So if food inflation remains high, it has 39% weight in the consumer price index, I think then the expectation of inflation becomes very elevated, and because these are the things that you buy on a daily basis, I mean vegetables, etc. So you have a perception that inflation is high, and that actually expectations begin to rise on inflation front. And also because of this, there is a fear of it getting generalized. So I think central bank, that is why, is not going to ignore persistent high food inflation. It will have to respond, and the only tool it has is interest rates. So that is how it is playing out right now.
Gold falls after China stops buying. China's central bank did not buy any gold last month, ending a massive buying spree that lasted 18 months, helping push gold prices to a record high in May, Bloomberg is reporting. Spot prices for gold fell about 1.5% after the People's Bank of China, or PBOC as it's called, said its bullion holdings were unchanged at the end of May. The bank has been adding to its gold reserve since November 2022, along with other central banks, including India. One trader told Bloomberg that China will continue to buy gold, but it's pausing because prices are so high. Gold had hit an all-time high of about $2,450 an ounce in May. Gold prices in India, which obviously track international prices, are also soft or stable at this point, though the outlook is still bright. And perhaps it goes back to the point that trader made about China resuming its buying once prices level off. First quarter purchases by the world's public institutions were at record levels, with China the biggest buyer, according to the World Gold Council, quoted by Bloomberg. More on China. China is exporting even more as countries like the United States raise tariffs faster. China's exports grew at a faster rate in May, with outbound shipments rising 7.6% from a year earlier in May, up from the 1.5% increase in April. The result topped the 4.8% growth expected by economists in a survey by the Wall Street Journal. Shipments to the economies of the Association of Southeast Asian Nations, China's top trading partners, rose almost 22% in May, accelerating from April's 8.2%. Exports to the United States rose about 3.6%. That was reversing a decline from April. Now, all of this is tricky, if not bad news, particularly for countries who are trying to control the imports of goods at much cheaper prices, and also suggests, as economists have been saying, that China is ramping up production and in some ways dumping in world markets. US tariff increases, by the way, will start kicking in later this year. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.